Did you know that India's economy contracted by a record 23.9% in the first quarter of 2021 in the aftermath of the COVID-19 pandemic? Did you know that since then it has rebounded? And in fact, in Q3 of the current fiscal year, it recorded a staggering growth of 8.4%. In fact, this momentum is likely to be sustained, and India may end up with a record 8% growth this year. Hello and welcome to another edition of Capital Calculus. I'm your host Anil Padmanabhan. The run-up to this year's general election is seeing an exceptional macroeconomic backdrop. I have never seen any incumbent government being blessed with such benign circumstances. India's foreign currency reserves are flush, inflation is decelerating, and most importantly, private sector capital expenditure is finally beginning to kick off after a gap of over a decade. And then you have the new numbers on India's gross domestic product. The GDP for Q3 for the current fiscal year, which is 2023-24, came in at a staggering 8.4%. This is nearly 2% higher than any analyst estimates. On top of it, you have new national consumption numbers which tell us that India is trading up. Whether it is rural or urban India, there is a pivot away from consumption of food to non-durables. What does one make of all this? Is this too good to be true, or is it signaling something much more? To understand all this and more, I spoke to Arjun Nagarajan. He's a chief economist at Sundaran Asset Management, a Chennai-based mutual fund. I began by asking Arjun whether he too was surprised by the big jump in the Q3 numbers for India's gross domestic product.
So let me address this two ways. So since the numbers came in, the 8% plus numbers, there's been a lot of noise, a lot of narratives talking about how this might be positioning from an election point of view, or could this be tampering with the numbers. So our profession is to look at the numbers in detail. So I think the first thing one should do is to completely discard all these narratives. The numbers are what they are, and the discrepancy that you see between the GDP numbers, which are 8% plus, and the GVA numbers that are much lower, is largely because of this component called net indirect taxes. So normally that your GVA plus your net indirect taxes is your GDP. This time around, for whatever reason, there seems to be a very sharp drop in subsidies. And your nominal GDP numbers are also much lower because your WPI is barely anything in the December quarter. So that has sort of really distorted the reading of the GDP numbers. Plus, there has been a lot of revisions in the Q3 of the last year that has caused more concern, more rather noise around the numbers. So, long story short, I think the better way to look at the GDP numbers to cut the noise out is to probably look at GVA. But the best thing that we always suggest people to look at is always look at it seasonal. Either you can look at 4-quarter trailing GDP growth numbers, or best is to look at a 4-year CAGR as to from pre-COVID to now, how are the numbers looking like. So from pre-COVID to now, I think 4.8% is the CAGR, 4-year CAGR that India is seeing. It's gone up from 4.5% or so. If you look at the 4-quarter trailing, we are seeing GVA at around 7.2% and GDP around 7.7. So long story short, I think the numbers are good. The activity on the ground is fairly strong. Short frequency indicators are telling us the same thing. You look at toll collections in volume terms or value terms, e-waybill, whatever the metric you look at, there's a fair bit of strength. So I think one should read this as a directionally positive number rather than really hold on to a particular number and say, no, hey, I don't believe this 8.4, I don't believe this. Better would to look at is maybe it's around a 7.5 plus. That would be a better way of looking at it.
So this pickup in momentum, which is visible in the post-COVID phase. So is it also possible that this extra surge is coming because a lot of the pressure due to COVID, subsequent Russia-Ukraine war, US Fed,
Mhm.
these are
Mhm.
also retreating. So maybe the momentum gets exaggerated
Mhm.
and amplified. Is that possible?
Yeah, that is quite true. So in statistics, you use this word called base effect, in the sense that when you look at growth in a particular quarter, you have to see if the same quarter last year has had a lot of noise, or has it seen strong growth or weak growth. Accordingly, that sort of distorts the number. So which is why if you look at seasonally, I think it gives you a better picture. Now, to answer your question, if you look at quarterly growth, Q1 growth, Q2, Q3, Q4, if you look at whichever quarter, if you look at the growth rate in these quarters on a Q on Q basis, on a um, consecutive quarter basis, I think you can see that there has been a pickup in quarterly momentum in the December quarter. Um, from a pre-COVID phase, whatever your quarter-on-quarter growth was, we are still running at a higher quarter-on-quarter growth than what it was pre-COVID. So across a number of segments, you still have that inherent momentum that, to an extent, you can attribute to the continued sort of demand pent up from post-COVID. For example, you see it in hotels, you see it in travel, you see a lot of these pressures that you have seen in these particular sectors, which is largely a post-COVID phenomenon. There hasn't really been as much pre-COVID. So that momentum is still very much there in the numbers.
So, Arjun, quick follow-up. It's very unlikely from what you just said that this momentum will let up in the final quarter of the current fiscal year.
Correct.
So, it is likely that this growth is going to be higher than what everybody has mathematically computed, right? So, you may
Mhm.
end up with around an 8% growth.
Yes, yes. That is exactly what I think the RBI governor, Mr. Shaktikanta Das, he made a comment, I think yesterday or the day before, talking about how FY24 is likely to close very close to 8%, which means implying that probably for a Q4, the March quarter, we're looking at somewhere closer to around a 7.5, or probably marginally above. That is what that statement sort of implies. So, like you said, yes, there isn't any let up in momentum one can see. For example, if you look at the PMI numbers for India for Jan and Feb months, they're continuing to hold up. Services and manufacturing are holding up quite well. So, it's very unlikely to let up in the March quarter.
So, now, Arjun, for this growth rate to be sustained, it requires the private sector capex cycle to kick off because so
Mhm.
far the government has been holding it up. My
Mhm.
feedback is that if you look at the BSE listed companies or the NSE listed companies, that there is an uptick in private sector capital investment. What's your feedback?
Yes, no, you're right in that sense. There has been a pickup. Your new projects have gone up, but from a market point of view, probably people were expecting the pickup to be a bit sharper and a little faster than what it is on the ground. Apart from that, I think you are seeing green shoots, especially from a private capex point of view. What may be to an extent has delayed it, maybe the uncertainties that we've actually seen geopolitically and otherwise over the last 1.5 years or so. And even, let's say, for the last 1 month, you've actually seen a lot of disturbances in the Red Sea. The geopolitical tensions are still very much there. Russia, Ukraine, and the commodity price pressure was one very significant disruptor in a certain sense. But yeah, so as long as these geopolitical disturbances keep popping up, the chances of that disruption also still remain. But yes, you are seeing green shoots on the ground. You are seeing an appreciable sort of a pickup in private capex as well, though the government capex still continues to dominate the narrative.
Recently, the government released the national consumption numbers. It showed that For the first time, spending on food had dropped below 50%. Instead, people were redirecting their growing disposable incomes towards consuming consumer durables or investments in education, transport, and so on. So I was curious to know whether India's aspirational economy was finally beginning to take root.
Certainly, certainly. So let me answer your question in two parts. So, firstly, what the survey tells us is something that, from a market observer point of view, we've always sort of heard from corporate commentary as well, saying that there seems to be a fair bit of momentum in rural. So, two things that the survey tells us: one, the extent of rural spending seems to be much higher than what it was earlier. So, for example, if urban India spends 100 rupees, on average, rural India spent 54% of urban spends. Now it seems to have gone up to around a 58. So, which means that on the spending front, the gap between rural and urban has narrowed. But having said that, if you look at the top quartile within urban and rural, you can see there seems to be also an increasing divergence between the spending ability of the top quartile, the rich class in urban and the richest class in rural. That there seems to be an increasing divide, but on the whole, on aggregate, if you see, you are seeing a narrowing of the spends between rural and urban. Now, coming to the aspirational part, that is a structural story. So, if you look at by 2030 or so, if you compare 2005, 2010, 2030, if you look at the last couple of decades, you'd see that nearly 25% of India that has been in the lower income and the lower middle class category will be moving to the higher middle class and the higher income category, nearly 25%, which means immediately there will be a very significant impact on consumption. So one number that keeps doing the rounds, that keeps coming up in a dozen of presentations, is this $2,000 per capita GDP number. So globally, you see whenever an economy crosses that $2,000 per capita GDP number, somewhere in the range of 1,800 to 2,200. The minute you cross that range, we crossed that just after COVID. You've seen a very sharp pickup in consumption of durable goods, especially, let's say, passenger cars, consumption or penetration of two-wheelers, of washing machines, of air coolers, all of these air conditioners, all of these have seen a fair bit of a pickup. So we are exactly where China was in 2007 and 2009 when China crossed the $2,000 per capita GDP. You saw a very sharp pickup in passenger vehicles. You saw the same thing in South Korea. You saw the same thing in Indonesia. Indonesia, I think your washing machine penetration went up nearly 2x. Your penetration of refrigerators went up 3x. So India is not going to be any different.
Arjun, a few months from now, a new government will take charge at the center. Now, from all that we have discussed, it's very clear that the Indian economy is at a point of inflection. So, which also means, I mean, I'm assuming that you need a new policy framework, right? Because the existing policy framework won't work for an economy where you're talking about per capita GDP of, say, even $5,000.
True, true. So I think the broad direction I think has been in place. So the last probably since 2014, under at least this particular political dispensation, back to back, their focus has been capex, 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 and only capex. So that narrative is not going away, and I think they understand the importance of that. And this last month, when the union budget was presented, the biggest surprise from a market's point of view was the fact that despite the pressures that they did face on the spending front, they continued to go ahead with fiscal consolidation much sharper and much more aggressive than what the markets had expected. That was one that we saw. Second trend that we saw in the budget was the fact that they were willing to actually increase capex at the cost of cutting revex, especially during a pre-election budget. Though it's an interim budget, at least it gives you the direction. despite the fact that you have those election pressures, they were willing to cut subsidies, they were willing to really cut back on revenue expenditure. And the third very interesting trend that came out was the fact that they are trying to get more states also on board, because they understand at the end of the day, center can't just do all the heavy lifting. It has to also be states getting on board. So you're seeing more incentives, more loans given to capex, incentivizing them to do the capex. So the initial budgets that you've heard from the states over the last month or so, you've seen some positive narratives from a capex point of view in some of the states, not all of the states. I think that narrative is going to take some time, but I think they understand the importance of the hour is to actually focus on capex, and the next decade should be, and rightly so. So they are doing capex, they're doing spending, but not at the cost of fiscal prudence, not at the cost of their debt to GDP correction. So they continue to look at a lower debt to GDP that is driven by a lower fiscal number, continued fiscal prudence in that sense. So I think the broad building blocks for this this developed economy that we are talking about in another 10, 15 years, I think that broad framework is there. I think the nuts and bolts are getting there.
But there's one missing policy item which is in this framework you just set out, is the factor reforms. So you have labor and capital on both issues, labor and land, on both in land in the first term and labor in the second term, particularly, and farm, the farm sector in the second term. It had to walk back all these reforms. So it requires a buy-in by states. Given the current state of politics between center and states, do you think there can be a grand bargain where, like in the case of GST, both the entities can come together for national good?
There's too much of politics in these two narratives that Dan I would sort of like. So I would only be hopeful that it actually comes through in a win-win sort of a situation. The farm laws, I was a little disappointed that it didn't really happen the way it should have, especially because in the long term it is in the benefit of the farmers. So I think at some point in time you need some convincing, you need some coaxing at some point in time, some incentivization. It has to be a mix of all of them. I would think that over a period of time they would get that mix right, but I wouldn't want to hazard a guess because there's too much of a political angle to this.
It is clear that India is at a point of inflection. Its economy is transiting from a low middle income economy to one which is richer, but yet middle income. This will require setting new goalposts for India. Let's take the example of poverty. The fight is no longer against abject poverty, which, based on the new consumption numbers, suggests it is probably less than 5%. Some claim it is 2%. Instead, it is about nurturing the new middle class that is emerging. Making it easier for them, teaching them how to fish, easing the way we do business. For all of this, especially to exploit the potential of India's farm sector, land and labor, we require a new policy framework, completely new, a new policy wardrobe as it were, which in turn is dependent on the government that India elects in a few months from now. So as they say, think before you vote, because you're literally voting for your future. I hope 900 million Indians are listening in. Thank you for watching. Don't forget to subscribe to StratNewsGlobal on YouTube. Hit the bell icon so that you don't miss any updates. And please do share your thoughts, ideas and suggestions with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.